Hey there, Michael Hopkins from Seeking Alpha. I'm again with Jennifer Warren, Seeking Alpha contributor, and also with Concept Elemental. Um, Happy New Year.
Happy New Year. We're off to a start, huh? A good
I
start.
mean, yeah, it's already been a lot of developments already in the new year, lots of changes. A lot of things going on, not only just with the markets in general, but energy as well, too.
Mhm.
So I think we should just get started. Not only just looking at 2023, some of the big themes coloring your view, some of the things that you're looking at in terms of energy and where things might go.
Sure. So I have sort of three themes, and one of them is just that I think efficiency is a big driver, not just this year, but in general, and as it relates to the energy transition and oil and gas production. I mean, it's all one, it's all connected. And then the other theme is just scale. Scale it has been a theme in energy. It continues to be a theme in it, and I think you're seeing that increasingly, given the things we're going to talk about. And then just that energy is connected to everything, and it's starting to really manifest in the market, in the stock market, and just driving a lot of business activity. So those are my kind of overview
Yeah.
ideas.
So it seems like, there's a lot going on, geopolitics, slight supply and demand drivers. You want to talk a little bit about the fundamentals of oil, some of the drivers they're going to be, people are going to be looking at?
Sure. And some of this, I'll skip over to these slides because I think this will be, let me just screen share. Um, this will help with some of this discussion. So can you see okay? Do you have,
Yep.
okay. So basically, and this is something that Scott Sheffield was talking about in a recent Goldman Sachs conference. And he was just, and it's funny because I think when we talked last time and I was talking about oil prices and just that, something like the futures curve was at WTI 71 and it wasn't mirroring reality at all, what was fundamentally going on. And it just seemed kind of out of whack to me. And funny enough, Scott clarified this with this chart, which is really cool. So he was basically saying that prices are hard to predict via the futures curve. And that's what is heavily relied on. And if you look at this, I was sort of looking at this a little bit more deeply, and this is interesting. So in this peak here, this was like right before the financial crisis. You had oil, I don't remember, it was like 140 or something, and then it bottomed out during the financial crisis. And then over here, these, the spot prices in the blue, that's when the advent of shale oil really started, when it really started like revealing itself. And then boom, it goes down. And that's when OPEC decided to retake market share. And then you have the pandemic here, it bottoming out again. And then you have, prices rising to like whatever they were, 110 or so, and then coming back down. And so you see this futures curve here, the green, it just, it's not predicting correctly, accurately. And I think some of that has to do with just volatility, for one. And obviously geopolitics is a huge driver of the volatility. But here's this next slide and here's some outlooks on prices. And I mentioned last time, someone I was speaking with, they had an $80 to $100 range. And, the Brent futures curve, it's going down to 80. And then Goldman Sachs is saying, somewhere around, like here we are at the first quarter 23, 90, and then going up to 105. So through 2024, I think that's right. And I don't think the price is going to go down like that curve, illustrates either. And part of the setup, again, is what we've talked about before, is that there's underinvestment in the industry. And there's still a floor under demand regardless of, the recession, there's still a secular floor, and whatever a recession might taketh away, when China comes back online, it's going to cancel that out. They sort of like will wipe each other out. China will pick up the slack of whatever recession is going on. And then I think the next slide, and this is and that's a terrible, it doesn't even look right. Oh, it got cut off. Basically what that's about is that's actually China GDP expectations. And this right here in this 0, this is like when COVID began. And then they're expecting in like 23, 24, 5 and 10% GDP growth. Hard to say if that's going to happen. That, seems a bit high and a little bit inaccurate just from things I have heard. And then, we always have this inelasticity of supply and demand and we've discussed this with demand that, there's a floor, there's a base of energy, oil demand. And I think it got down to like 86 barrels, 86 million barrels per day at the low point of the pandemic. Now it's back up to 100, then it's 101 projected next year. On the supply, and I think I'm gonna stop share. Well, I'll talk about LNG a little bit. On the supply side, back to oil, with pricing, OPEC is not going to let prices go too low. They need them to be higher. And Scott was saying something like, 90's good for them. They don't really want it much below that. And so they would cut supply, if it starts coming down again. So you have OPEC moderating price for one. And then the other thing too is you have restraint in the industry, where producers, majors, independents, they are not going to produce guns a-blazing, like in 2013, 2014 and on. It's just not going to happen. And part of that setup has to do with the energy transition. And we can get to that a little bit in a bit. Back to, I'm trying to think if there's anything else on supply. So there's no incentive for firms to really pump a lot and put in a lot of, add growth. It's just, they're going to stay moderate. They're going to return dividends to their shareholders. And then the other factor with the industry is back to this underinvestment story with oil and gas. Oil in particular, we're talking about is the reserve. This is something Scott talked about. Reserve replacements are below their historical norms, including the independents. And what that means is they're not spending as fast and furiously to keep those reserve replacements higher, and which was the case back at the advent, of the shale oil boom. So it's setting up higher price. All this is setting up a higher price and the prospects of M&A activity. And then the other thing Scott mentioned was that there are a few countries that can or will ramp up production, to meet any, increase, rapid growth. And it's just not going to happen. It's not, the setup's not that way. And especially with interest rates rising, it's just the growth of before isn't going to happen like it happened. It's going to be moderate. And then CapEx is constrained with oil and gas producers. This is just flipping over really quickly to natural gas LNG. This is a slide that was from the Fed presentation. This is from Tellurian. Basically, and we talked about this before, just that, all the LNG plants here on the right that are under construction, there's like 446, that's the LNG capacity right now. And then it's pre-FID, it's doubling that capacity. And then all the projects that have geopolitical risk, like in Mozambique and other places, Russia, not going to happen. They're happening in North America, generally. See this green? That's all United States LNG plants. Now back over here on the right-hand side, this is global demand. And in 21, you had 389, million tons per annum. And then it's by 2040, you're supposed to almost double it again. And if you look at this, which is interesting, so Europe, sort of doubles their LNG needs. China, 1.5 what they were. But look at the rest of the world, look at the demand for LNG in the rest of the world. That's something that, people don't talk about. Everyone focuses on Europe and China, and, the rest of the world is demanding LNG too. Well, who's a benefactor? The United States is going to be a big benefactor. And then that's going to be more energy transition stuff when we get it back over there. So I'm going to stop sharing. So that's kind of.
Yeah. So looking at that, and one of the things we did talk about just prior to getting onto the call here, geopolitics does have this big impact, much more. Maybe people probably know about the impact, but it does seem like not just what's going on in Europe, it's also going on with China, all those kinds of things. This is going to maybe be a story for 2023. Maybe you can talk a little bit about that angle with geopolitics.
Sure. Relative to China, I had some notes. Oh, here they are. China's a huge consumer of, I think their oil demand dropped. I heard something like 2 million barrels by 2 million barrels per day during the pandemic. So those are barrels that are going to come back on, right? That are going to pick up over time over the next, couple of years. They consume 1/5 of the oil market. That's huge, right? They also consume 50% of copper, nickel, and zinc, and like 3/4 of iron ore. So of course they have an influence on price and also on the price of LNG. And also there was some talk about, the IEA expects LNG demand to increase 25%. And if China and Europe are competing for LNG, which they will be, right? Because Europe's not importing as much from Russia, one of their key suppliers anymore, that they could be short 7% of their annual demand, and that could therefore lead to some rationing. So you could see some spikiness, in natural gas LNG. And one thing that Scott Sheffield talked about, we're at about $4 Henry Hub. And, obviously Europe and Asia are higher. And he was just saying, and this is something we talked about before about the globalization of natural gas market. And we talked about it in the context of George Yates and the Solving Europe's Energy Crisis article, because he's a big global natural gas producer. He's in that market. And we were just saying that, back in October, I was noticing that, the contours of a global natural gas market were not quite yet clear. We didn't know what countries were doing exactly to redress the Russia shortfall. Now we're starting to see, right? Germany's building all these LNG plants. Well, that tells you what they're doing. They're going to import LNG, and they're not going to be, importing it from Russia. And they're going to import it from us and probably Qatar, other places. And so that's one factor. And now you're starting to see the contours starting to emerge about this natural gas world. And one thing Scott said is he hopes for, a global a global price for, LNG and gas. And he thinks too that longer term that the US will be at 6. And I think that's right. I mean, it's a bit on the low side right now relative to all the factors, the factors that we talked about with oil relate to gas, because, you know, especially like in the Permian, you know, if you're producing oil, there's a lot of associated gas, and pure play gas companies are also, you know, practicing restraint as well. They're not doing, they got burned at the advent of the shale gas revolution, you know, so they're all, you know, moderating. You know, no one's going to do guns blazing production anymore. So, and back to the geopolitics. So like I said, you know, China is a huge, you know, competitor for natural gas. They're the largest importer of oil, and they're a, you know, OPEC's key customer. So, and they're obviously buying more, you know, oil and gas from Russia. So you do the math on that, and it's, the geopolitics are really, they're more complicated, you know, and it's a lot more dynamic, if you will, and it lends itself to a little bit of a unpredictability in some respects. I mean, Russia did what they did, and that ship sailed, and we're still seeing all the repercussions, and Europe is diversifying more of their natural gas resources. You know, they'll probably end up producing more over time, and, you know, and the energy transition weighs into this. And then one other thing I think we were going to talk about real quick too is like the Permian, you know, just as a proxy, before, you know, what's interesting about the Permian is because now, okay, I think the production there's like 5 million barrels per day right now. That's 5% of the global market, you know, and it's a stable 5% of the global market, you know, relative to things that can happen in volatile countries, you know. So it helps moderate some of the pricing in some respects. I mean, you still have volatility because you have oil deposits in lots of, you know, geopolitically risky areas. But with the Permian, Scott was saying that the expectation is that it will grow. Its peak might be about anywhere from 6.5 million barrels a day, maybe 7, possibly 8 at a peaky kind of point, lower than what the IEA, that's the US energy watchdog, lower than what they're projecting. And that once, and he thinks it's going to probably be around 2030, I believe, you know, don't quote me, but I think that's when that expected peak of the Permian. But then after that, it's going to plateau and just keep riding that plateau for like up to 30 years. And there are reasons for that. And part of it too is, you know, technology and enhanced oil recovery. And that's kind of, that enhanced oil recovery is kind of a piece of that energy transition puzzle related to oil and gas. And we can I'll mention that when we kind of switch back over into that. And then also in the Permian, you know, just that, yeah, there's going to be more M&A activity, and it's not just the Permian. I mean, you may see it there, but so that's going to be really interesting. And he really expects massive M&A, and that means that's back to scale, right? It tells you that with the energy transition, you know, there's a consolidation, and we're just, and consolidation and scale and M&A gets back to efficiency, you know, which is my ongoing theme. And now with capital costs rising because of interest rates rising, it just makes it that much more real, you know. And then quickly about the Permian, so there's like 3 players that, you know, are big producers and that will continue to be big producers. And Sheffield was saying that, you know, Pioneer, Chevron, and ConocoPhillips, you know, COP, CVX, PXD, you know, they all have the capacity and do pump 1 million barrels a day. I'm calling them the Million Barrel Club, and
Mhm.
they're going to be able to do that after 2030, after that peak happens. And so that's really interesting, from an investment point of view, right? And I invest in both PXD and CVX. Gas, one other comment about gas is just that over time, gas, and we know that the metrics on gas is just good. And part of that's because of using more natural gas on the grid, and that it also complements renewables. And it's just a transition fuel. People debate about it all the time. Is it a transition fuel? Oh, it's a transition fuel. What? It's a transition fuel. It's a fuel. It's used. It's heavily used. Call it what you will. But that the gas helps with efficiency, with capital efficiency for oil and gas, because with greater price realizations over time, and just it's got more value. It's going to have more value than it did at different points, and so that helps with capital efficiency. There's some pipeline issues in the Permian because of the gas, and they're going to have to add, like he said, a pipeline every 18 months to 2 years, over the next few, probably till the end of the decade, just to handle the gas and to deal with things like what's happening at Waha and stuff like that. Rig constraint, they're not going to be just throwing up rigs guns a-blazing anymore either, and that there's an increasing movement to electrification with operations, and that's just, I've noticed that's something, that article I was working on relates to, just that oil and gas operations, they're trying to find ways to do it more clean, tie it to the grid. If there's renewable capacity that they can source, just to cut down on carbon and emissions and greenhouse gas emissions. And so for 23, the expectation per Scott is that the Permian will grow 700 to 800,000 barrels a day, that kind of increase, not 1 million, which is what the watchdogs are projecting. And I would vote with Scott on that. So that was that on the Permian. And then we covered one other thing I'll say about China that we talked about, the geopolitics issue, is that Goldman, on pricing of oil, expects a $15 hike because of China, once China's just kind of on board. And then the other thing that's interesting, and this probably relates more to energy transition topics, but yeah, okay, so we see supply chain shifts with, China's cozying up more to Russia, and OPEC is a bigger, China's their key customer, and so that's a bit of a supply chain shift compared to the last 5-10 years, of who's importing from whom, and who's exporting and all that. Those relationships are changing some, and that's a supply chain shift. But the other supply chain shift is all the energy transition, and that is just in flux. And, we can only just start seeing some announcements and things. We can't really see any, major trend except for the ones that we have observed, right? So,
well, let's get into that. I think getting into the conversation about the energy transition, that seems like that could be the 2023 story, but it also sounds like it's going to be a long term situation in terms of how this goes, especially when you bring up things, and maybe this is not part of the transition conversation, but consolidation, trying to scale, it's stuff about when you talk about efficiency. Maybe you can get into some of that.
Yeah, well, no, I mean, you're dead on, Michael. The transition is a driver of efficiency. It's a driver of resource efficiency. the transition is because we're trying to we're trying to do things better. We're trying to work with the resources we have. And we know that with oil and gas and coal, that we have these externalities called pollution from combustion. And we're trying to deal with the greenhouse gases. We're trying to deal with global warming. And the best science we have right now is that we need to cut emissions, and hence the push for renewables, obviously, because they don't emit. Now, building wind turbines and developing, the solar panels and all that. Now there are environmental costs to that, and that's a whole nother story. But the drive with oil and gas, and it's reflected here by this chart. So this was something that Bloomberg NEF pulled together in the Fed conference. And right now, oil and gas in 2021, they spent, and this is amongst roughly 40 oil and gas companies, and they spent almost 7% of their CapEx on low carbon investment. Now that was higher in 2015, and that was actually, when things were really growing, and there was, probably there was just more money, that could be spent on that. And so I think you're getting into this sort of like, here we are, and this is reality, and it's going to grow. But it's going to grow in a certain way, and it's going to grow relative to these oil and gas firms' strengths, their competencies. And we discussed this actually last time in that intricacies of the energy transition. And I think, again, we're just getting more clarity because of the, let me try to get to there, because of the IRA. And, it's like 128 billion of credits for wind and solar, but relative to oil and gas here, the CCS, the carbon capture credits, 3.2 billion. And then on the other side here of the infrastructure law, which was passed in November 21, you have 18 billion of CCS projects and infrastructure. That's, call it 15 billion. Hydrogen hubs, almost 10 billion. Clean hydrogen tax credit, 13 billion. That's like 22, 23 billion in hydrogen. And I've seen more hydrogen announcements recently, and I think CVX even had a hydrogen announcement. Something that Pioneer is focusing on, and this really makes sense because it's part of their competency, and it aligns with their core of being an oil and gas producer and producing at the lowest carbon intensity barrels they can at the lowest cost. And so they talked about doing more with CCS, and that relates back to the enhanced oil recovery, which relates back to the Permian plateauing for decades, that you can use, the CO2 to help, get the boost and get more oil from the ground over time. And he even said, it works. Now, Oxy has been doing this a long time because they've had a lot of Permian acreage for, decades. And part of their acreage is in an area that nobody really talks about much called the Central Basin. The Permian is 3 basins. It's the Delaware on the west that also is in New Mexico. It straddles New Mexico and Texas, and then the Central, and then the Delaware. The Midland, and Pioneer is, a Midland player. But Oxy's been in the Central Basin doing enhanced oil recovery, EOR, for a very long time. So they're good at, getting to the last drop, so to speak. I mean, no one gets to the last drop, but that's kind of the idea. And they did it in California, so they have a lot of experience in it. And I increasingly see why Warren Buffett really likes them. And Oxy is also really focused. They have a low carbon venture. I think it's called 1.5, and they're doing those direct air capture demonstrate projects and all that stuff. So they're trying to see what's going to emerge, but they're definitely leading, and they have competencies related to it. So you're seeing all these different firms are distinctly differentiating what they're going to do in the energy transition. Let me see what this next slide is. Okay, now this was something that, again, what we were talking about with the transition and oil and gas, something that kind of came to mind was, okay, in this Bloomberg scenario, again, this is from the Fed conference, from the analysts there, and it's different scenarios. Like the green is if, heavily renewable power growth. The gray includes more CCS, carbon capture and storage, growing significantly. And then you see over here, this is 2026. So this is the next 3 years here. And then this is up to the 5 years hence after that. The red scenario is more of a electrification growth and nuclear going together. So what's really interesting is here in this gray section on both sides, the next 3 years and the 2026 to 23 era, CCS is actually requires less. It's cheaper in terms of transition net zero goals than more of the pure renewables side of things. As you can see, in this second half of the decade, the renewable hydrogen route is more expensive, as is the nuclear route over here in the red, and the renewables and the nuclear route. So that's kind of interesting, I would say. And I think that seems like it's a good path, right, for oil and gas firms. They're going to do other things, absolutely. They are doing other things. I mean, they are using renewables in their operations, and then there's certain majors that are investing more heavily in renewables and offshore and things like that. But this is interesting too. This hydrogen, this red bit is hydrogen, and I was sort of eyeballing the hydrogen and then the CCS over here, roughly 400 billion. On both of those potentially. And that's interesting. If you look at the IRA monies we just looked at, that's a lot of money relative to what the IRA is spending over 10 years. It's a drop in the bucket, really, what the IRA, but it's still a signal, and it gives these firms a runway to try, with some tax incentives, with some government support, to try to see what becomes economic. And, again, it's back to that, where's the money going to stick, and what's going to be the winner? We need all of it. We got to try all of it. And then this is just back to the hydrogen idea. And Tim Worth of Chevron, the CEO of Chevron, I was looking at a transcript, and he talked about, there's green hydrogen and there's blue hydrogen, and there's different, cost structures to both of them. And they were talking specifically about this ammonia area, because there's a firm that they're going to be partnering with. And so they're looking at that. And then this is also back to sort of more of a CVX story, Chevron. Their RNG, renewable natural gas, here on the far right, they're a leader in RNG. And I mean, they have a business that does this now. And I think they've partnered with somebody, but they were saying, you know, we have a model, basically saying we have a model, we make money at it, and there's going to be, you know, for a lot of the things they're talking about, including hydrogen things, there's going to be a lot of investment required for these things to really take off, to be, you know, consequential in the energy mix. So right now we're just talking about, you know, things, you know, on the margin, on the fray, and again, what is going to take off in the future. But I do think too that, you know, it's going to get really interesting. I think that was the last slide. Yes. Let me stop sharing. I think it's just going to get really interesting with what these large oil and gas firms buy, you know, what firms they buy, who they partner with. It's going to take a lot of collaboration. And remember, I said in the very beginning, you know, energy is connected to everything. And you're starting to see this more cross-discipline, collaborative approach. It's going to take tech. It's going to take know-how. So I think it's a really exciting time. And it's going to take more knowledge than ever on the scientific front, you know, just kind of staying ahead on, you know, okay, is this a technology that can really make? Can you commercialize this? Can you scale it? But I think what I'm thinking now with the oil and gas players is that that's frankly a good place to, you know, place bets in the energy transition, because, you know, they already have, you know, whatever, you know, they're making most of their free cash flow, you know, from oil and gas, and then they can start seeing what aligns with their core competency that complements what they're already doing. So you do see this transition more. You see oil and gas, I think, playing in it more than before, whereas we have this, you know, I mean, and people still see it like this, but I don't see it like this. You know, you have this oil and gas camp, renewables camp, you know, the big green divide. You know, I don't see it like that anymore. That's all rhetoric, you know, because if you're thinking about investment, you know, you have to see this cross-pollination, right? And because now the transition and what's happening on the greener side is influencing oil and gas more than before. So it's like you can kind of do it all. And then when you swing back to some of these the geopolitical factors and players and actors, you know, I think it's a real bullish case again for the US, you know, in the energy transition. Europe too. I mean, like we mentioned before, a lot of those really large utilities that are doing a lot in renewables, they're European. So, and also I just read about the North Sea. You know, Shell just announced that they're going to, you know, sell off their North Sea assets, and that they were going to go to other fields, newer fields, and couple that with the fact that a lot of the Scandinavian countries, including the UK, Northern European, are looking at the North Sea as an offshore wind hub, you know, and trying to leverage that. So that's interesting. Now, we still have some challenges connected to renewables development in terms of minerals. We still have the minerals, you know, do we have enough minerals to do all the renewables we want to do? I don't have the answer to that. Are we going to have to increasingly look at sustainable materials? Yes. Are we going to be great recyclers of wind turbines? Probably. You know, so there's all that's going to be happening too over time, I think. You know, having to figure out how to do things smart. I mean, so there's a lot of opportunity, really. I mean, when you think about it. So that's kind of, you know, what I'm looking at.
So it was interesting looking at those slides again. We did look at the slides before we got on, and then something occurred to me. So I'm hoping I'm not putting you on the spot. With this energy transition, there's a lot of investment, there's a lot of collaboration, but I also feel, and maybe I have this wrong, but there's a tight timeline to get this all done for some of these companies, or for all the interested parties.
Well, that would be one story. And that would be the story that, the urgency. I know what you're getting at. What you're getting at is the urgency because of climate change, right? That there's an urgency to get to net zero by 2050, basically. And I don't know if we're going to get there. If we have a technology breakthrough, possibly, highly likely then. Do we have the innovation, capital, and will to do it? Hard to say. There are so many varied interests amongst countries. That rest of the world we looked at for LNG, that is a huge part of the growth of energy. They're not all using renewables, and it's still a fraction, in the developing world, relative to the renewables capacity and generation that we have, that Europe has, and we're just incentivizing it, right? We're just now kind of, we're going to up this, with this IRA legislation. And then we have some headwinds via the grids, integrating renewables into the existing grids, and all those reliability issues. You saw that movie with Russia. You saw that movie with Germany, when before Russia invaded Ukraine, like we said, some of the cracks in, moving too fast, with trying to just green your grid, it's just, renewables are intermittent, and yes, the solution is storage, and there's a lot of innovative storage stories, and I've been seeing more of them, and I think you're seeing more of these stories because there's incentives in the IRA legislation to to build these facilities now. It's going to be more cost effective, but again, there still has to be grid efficiency, and that's a whole nother discussion. And I'm not an expert in all that, power gen. I sort of work with it more as it relates to oil and gas and the green story, but it's a whole web unto itself. And it's an obstacle. So that is one of the constraints on how fast you can move on electrification of the grid. And so that's why I think you're seeing these differentiated strategies like CVX, like Chevron, with biofuels and sustainable fuels and all that. Is, the thing about fuels is that you're not relying on the grid. They're mobile, they go with you. If you're transporting, if you're flying an airplane, do you want to go back to this hub and plug in? You need to, you probably need a tank. That's back to that. I said you still need a tank. There's a hybrid model, right, that we're having to look at until there's some great revelation about how to do it differently. And I don't know what that is yet. I'm not there, and the world's not there. So urgency, yes, need to do everything we can, absolutely. And I think there's a lot of different ways to deal with that that's connected to energy, and it has to do with resources and other things that are stuff I write about and think about. But it's a whole nother resources discussion.
Yeah. So let's wrap it up with the scale question. And you've already talked a lot about it already, but maybe just again, how does scale play into your ideas? What's the role? How's it set up for, discussions down the road?
Yep. I have a big chug of coffee before I sit down. Um, so scale. Now, there's a book called Scale, and it's really cool. And it's written by this theoretical physicist and one of the smartest men on the planet. And I interviewed him like 10 years ago, and I'm trying to interview him again. And you can look at scale in two ways. Okay, there's the scale of like in oil and gas where you have all the M&A and you're consolidating and the players are getting bigger because they need to produce the resources more efficiently, and now with interest rates higher, again, we're going to be using capital more efficiently. Smaller firms that don't have good balance sheets, they're going to get bought. And also just because of the issues we sort of touched on related to producing oil and gas in the Permian, for example, that we're going to eventually, Scott mentioned, a lot of these players are starting to go to tier 2 and 3 acreage. Some of the tier 1 is getting spent, and that's where this enhanced oil recovery comes in. Smaller players can't afford the CCS and the enhanced oil recovery route. They're going to get bought. So that's one factor of the scale with oil and gas. And then there's all those myriad equations to do with how much supply over time we need, the technology we need to extract it, what that forecast and scenario looks like. And that's we could spend 6 hours discussing that. And then the other scale factor, aside from capital efficiency, resource efficiency with oil and gas, is physics, the physics of resources. Many of them are finite, right? There's oil and gas essentially is finite. It's a finite resource. The minerals, the critical minerals that we're going to be mining for the energy transition, we also have limits on that. Now, our innovation minds, we can, look at what we do now. Look at the things with technology. Look at all the, the cloud, we talked about this, the cloud and Netflix and, our cell phones and all the stuff we do and all the tons of pictures we take and, our phones are in our back pockets, we're like really dependent on them and everybody wants them, right? The whole world uses them. And so it's a technology stack, right? Connected to all that, which also uses resources. And so if we're going to keep with innovation, layering on even more stuff, that's going to require energy and there's constraints. So you've got to work. So you have to be efficient. You have to scale all these things. This is, some of that fat's getting trimmed, right? With the triple Q, and, you see some of those valuations getting cut by a third with the tech firms because, some of the promises weren't being met that are made, and money costs things now, costs now for projects. And so there's more of an efficiency mindedness on that as well. And so I think, there's just a little more, okay, what's real? What do we really need? And what do we have the money to invest in? And, so there's kind of more, I think, of a rationalization of everything, in energy tech. And it's all coming together, and interest, money actually costing something is sort of bringing us all down to reality. Russia brought us down to a different kind of reality, changed the map, started changing the energy map, unbeknownst to them, and then China coming back on board, and I just saw some announcement that they want to dominate hydrogen, or I don't know, something like that. And that makes sense. Just because they do have a lot of renewables, and they don't have they're not producing a lot of their own resources. They import oil and gas resources to a large extent. So they're picking their path as well. So just, scale matters, in the future, and efficiency, they go together.
Yeah. Boy, that's a lot to think about. I mean, that's a lot of territory we covered there, from fundamentals to the geopolitics, dynamics within the industry. Anything else to add?
No. I mean, I think, just like I said, those bellwethers of the Permian, Pioneer, Chevron, ConocoPhillips. Now, I haven't studied ConocoPhillips as much, so I don't really know what their all their core competencies and things are. I know that there's one writer on Seeking Alpha that likes them a lot, and he's kind of green leaning, so I suspect they've got a good story too. But I find that interesting, and Pioneer has amazing dividends, and that's their strategy, really, as opposed to buybacks like some other firms, a lot of the big players. And I think that's a good strategy. And it depends on the cycle and things like that. But I like their strategy. I like cash back. So, but anyway.
Cool. Well, I appreciate the time. Thanks for the conversation again. Jennifer Warren with Concept Elemental. Again, thanks for the time. I appreciate it.
Yeah, it's good to talk to you, Michael. Hope to do it again. Bye.
Likewise.